we're going to talk about market volatility and how we can actually combat this a little bit. Welcome, Joseph.
Thanks for having me.
Hey, so the market is different today than it was 20 years ago. Agree, disagree?
Agree.
Yeah.
I think it's always going to be evolving into the future as well. We're never going to have this status quo or lower volatility. Things are always going to be changing. Investment tools are always going to be changing. It's why we believe in more of an active approach to the way that we invest our funds too.
So you would agree that the market is evolving, correct?
Absolutely.
Is the investor?
I don't know about that.
Yeah.
I think that there's a lot of people who believe in set it and forget it. And maybe that can work for certain scenarios. I'm not saying, you can write off that completely.
Right.
But I think that as far as people that are not educating themselves on the market and really getting involved or having that active management, there's much higher increase of the people that are not doing those things.
I think that there's a lot of things that don't work anymore. Buy and hold, dead. 4% rule, dead. There's so many different things that people used to do that they're like, oh, this works. And people are looking for consistent income, especially when they get to 65. Here's my biggest gripe at 65 years old. We want to stop investing, right? We have to remember that taking on risk when we were younger, saving, sacrificing, investing, going through ups and downs, making bad financial decisions, taking on what we thought was risk at that time actually got us to a point where we've accumulated money over time. But now we're 65 years old. I just had a birthday. They had a really nice cake and I'm done investing. Now I just want income. But you have to have growth on top of that. You have taxes and inflation. You've got healthcare costs. It is a different world than it was 20 years ago. And so I think that the investor has stayed the same, but the financial ecosystem that surrounds us has gotten more difficult.
Yeah.
And so we have to evolve in financial planning.
Even those individuals that say, well, I'm going to stop investing. I'm going to become very conservative. I'm just going to invest in CDs or bonds and things. That might have been great when interest rates were 8 or 9%.
Right.
But especially with interest rates coming down now, those conservative individuals, it might make it even harder for them to receive that income, or the people that are like, I'm just going to live off of the interest for this and I'm never going to touch my principal. With unexpected expenses in retirement, with healthcare, with long-term care, it's very rare that you can achieve that, especially in today's interest rate environment.
Yeah, and I think what people have to remember is it is the stock market. Remember the second word in that, market. What creates a market is buying and selling, different prices. No different than the art world, no different than the real estate market. Imagine if houses went from 100,000 all the way up to 1.5. There's no way that we can afford them. So it's kind of nice when they actually correct every once in a while, just like the stock market. Look, you're never going to climb a huge hill without taking a break. It's the same thing with the stock market. When you climb a hill, you're actually going to climb, you're going to get tired, you're going to take a break. When you take a break, all of a sudden you get something to drink, you get something to eat, you rest. That's what the market does when it pulls back or corrects. Then what you do is you gain more energy and it allows you to reach higher highs. That's why every time people say, well, the stock market is so risky, over time, it is positively sloped. Look at the S&P 500. In between that, you have some ebbs and flows, but that's just part of it. So how do we combat that market volatility and embrace it?
You have to have the right expectations going into investing, what to think about. And it's not necessarily about trying to avoid those pullbacks. You have to understand that certain pullbacks are healthy for the market. It's not about trying to avoid them completely or time things perfectly. It is very strongly about how you react to those pullbacks. If you are in a rational, and I hate to say the word irrational because we understand that fear that individuals have during certain time periods, what's going on in the market and whatnot. But if you're pulling your money, making these irrational decisions, moving everything to cash and waiting for things to clear over before you enter back in, it's not going to look great for you long term. And history has proven that, right? Getting out of the market on certain days, trying to time things perfectly. Time in the market is always going to be trying to time the market. And again, history trends has proven that. So you have to understand that certain pullbacks are healthy and set the right expectations for when you are starting to invest, especially in retirement.
Yeah, and one of the biggest things that I see is over-concentrated positions in non-IRA accounts where if somebody has a position and it keeps getting bigger and bigger and bigger. The problem is that you want to start to de-risk that portfolio. You want to be strategic, not reactive. And again, as we progress further into retirement, we want to make sure that that portfolio is evolving the way that we need it to support our income, the way that we need the income to support our goals and objectives. There's just so many different moving moving parts, but there is that financial infrastructure that plays into all different pieces of that. So again, if you have any questions or you want your very own retirement income guide, go to myincomeplan.com. You can download your very own retirement income guide today. Thank you so much for watching, and we'll see you on the back roads of retirement.
Do you have questions and concerns about your money, lifestyle, and retirement? Like so many, investors today worry about living expenses, healthcare costs, inflation, and stock market volatility. Instead of worrying, start planning. Eric Kearney and his team at Retirement Wealth Advisors want to sit down, get to know you, and start to build a plan that matches your vision and goals. Let's have a real conversation about what's important to you and how we get there. We'll help build you a plan based on your goals, lifestyle, and income needs, with financial clarity over complexity. Call us today for a farm fresh second opinion. Remember, you only retire once, so let's get it right the first time. Thanks for riding along with us today. We hope you got some good dirt. If you liked today's show, subscribe, like, and share with all your farm truck friends. We hope you'll join us for the next ride on Farm Truck Financial, where we're always planting seeds for a better future, 1 mile, $1 at a time.
Farm Truck Financial, we're riding with you down the back road steady.